Let's say you are an actor and a script lands on your desk. You read it, it seems fine, but it doesn't stand out for you, so you pass it. But later, that film goes on to become one of the biggest blockbusters. Now, you weren't careless, the script genuinely didn't look special at that time. It looked like everything else. Investing does the exact same thing. Bajaj Finance was right there, sitting quietly as a mid-sized NBFC. Solar industry is an explosives company. Apar industries, no one was screaming buy. And then 146x, 65x and 65x again. The stocks were right there and most of us either didn't notice or we noticed and still passed. So today we are doing something little different. We are going to work backwards from the actual winners and figure out what they all looked like before the market figured them out. Capitalmind, a really respected research firm, did exactly this. They went back 15 years, studied every single major multi-bagger in the Indian market and mapped out the common traits these companies shared at the very beginning. And the findings are genuinely eye-opening. So this is exactly what we'll be breaking down today. Hi, I'm Apar and in today's video, we'll be first walking through the 3 traits that almost every multi-bagger shared right at the start before anyone was even watching. Then, we'll try to apply this framework to the current market and look at 5 companies that are showing those exact same early signals and could be the next multi-baggers. But let's first see how Capitalmind built this analysis. They went back to 2010 and looked at every company on the NSE with a market cap of at least 500 crore. They only kept companies that actually survived the full 15 years through demonetization, GST, the IL and FS crisis, COVID, all of it. No shortcuts, no easy filters. That gave them 613 companies. Now, out of those 613, only 62 delivered more than 20 times your money over the 15 years. That is roughly 1 in 10 stocks. And they call these the superheroes. Now, before we get to what made these 62 special, let's talk about who didn't make the list. Because honestly, this was the most surprising part for me. Now, think about 2010. If you sat down with a financial advisor and said, give me a portfolio I can hold for 15 years, what would they have recommended? Almost certainly the obvious names. HUL, Nestle, HDFC, ICICI, TCS, Infosys. And look, those companies weren't bad investments at all. HUL gave 9.5 times returns, Nestle 8 times, HDFC 7.5, ICICI 7.6, TCS 6.2 and Infosys 4.4. Honestly, most of us would have been happy with those returns. But here's what's wild. None of these made it into the superhero club. The actual multi-baggers and beyond were Apar Industries 65 times, Persistent Systems 60 times and Trent 47 times returns. Companies most people in 2010 either hadn't heard of or had completely underestimated. So what was different about them? 3 things which are surprisingly simple. Trait number 1, and when I first learned about this, it felt almost too obvious. But the data behind it is really striking. Not a single future superhero came from the top 10% of companies by market cap in 2010. Zero. And 57%, that is more than half of all eventual winners, came from the 3 smallest market cap buckets. The median future superhero had a market cap of around 1200 crore at the starting line. The median for the rest of the market was 2300 crore. And the reason is simple. When a company is already big, a HUL or a TCS, what does 20x more even look like? It means becoming one of the 10 biggest companies in the world, and that's not impossible, but it's extraordinarily difficult. The base is just too big. But a 1200 crore company becoming a 24,000 crore company over the next 15 years, that's actually not unrealistic for a well-run business in a growing market. Plenty of companies do that journey. So that's the first lesson. The next multi-bagger is mostly in a part of the market we aren't watching closely right now. Now, trait number 2. Think about school for a second. If someone offered you a bet, pick the kid who will be more successful 15 years from now, most of us would pick the obvious topper. The one already getting straight A's, already impressing everyone. But stock markets work a bit differently. Here's what the data shows. The future superheroes were trading at a median PE of just 14.2 times at the start, while the rest of the market was at 18.4 times. Their price to book was 2.57 versus 3.19 for everyone else. So basically, investors were paying a 30% premium for the popular, well-known names. But If you fast forward 15 years and those same superheroes were trading at a 60% premium to the market because the market had completely changed its mind about what these were worth. And this is really the key thing to understand about how multi-bagger returns actually get built. About 15% came from actual earnings growth, but another 11% came from what's called re-rating, which is just a fancy way of saying the market realized it had undervalued these companies and started paying more for the same rupee of earnings. Now, earnings growth alone would have given you roughly 8 times over 15 years. That's actually pretty good. But it's earning growth plus the re-rating that turned 8x into 20x or 50x and in some cases 146x. Now, let's look at the third trade. Let me give you a really simple picture. Imagine you own 10% of a pizza, but every couple of years, the restaurant owner starts cutting extra slices and handing them out to new customers. So your 10% becomes 9%, then 8%, then 7%. Basically, the pizza is getting bigger, but your slice is quietly shrinking. That is what shareholder dilution feels like. Now, here's what the superheroes did differently. Over 15 years, these companies diluted shareholders by only 14%. The rest of the market, 35%. They were generating enough cash internally to fund their own growth. They didn't need to keep coming back to investors asking for more. Now let's put all these three traits together: small size, fair valuation, and self-funded growth. You start to see exactly how the math of 20x and 50x returns gets built. Now, here's the part I actually think is the most important in this whole video: the patience problem. Everyone wants 20x returns, but nobody wants the journey that comes with it, which can be brutal, yes. And this is what the data shows about owning a future superhero. The median superhero stock spent 39% of its entire 15-year run in a drawdown of 20% or worse. That means for nearly 4 out of every 10 days you owned the stock, you were sitting on a painful drop from a previous high. And the median winner went through a single stretch of being underwater for 3.4 years. Not 3.4 months, 3.5 years. And the hardest part is actually the boredom. See, most of us think we can handle a stock going down. It hurts, but if we believe in the company, we can hold. What actually breaks people is watching a stock do absolutely nothing for years, just sitting there flat. And Capitalmind actually measured this. They tracked what they called flat stretches, basically periods where a basic 5% savings account would have beaten just holding the stock. The median superhero's longest flat stretch was 3.7 years. And every single one of the 62 superheroes, all 62 of them, went through at least one full year where a savings account beat them. All 62, not most, every single one. Now let me make this real with two names you will definitely recognize. Eicher Motors, one of the greatest wealth creators in Indian stock market history. It compounded roughly 65 times over 15 years. But from September 2017 to April 2024, that's almost 6.6 years, essentially flat. A savings account would have beaten it through that entire stretch. 6.5 years of nothing. Bajaj Finance tied for the number one spot in this study at 146 times over 15 years. But it's been largely flat since October 2021. That's almost 3.5 years of frustration for anyone sitting in it right now. And here's the stat that I think just destroys the biggest myth in investing. Out of all 62 superheroes, only 6 were smooth, clean compounders throughout. Just 6. Solar Industries, PI Industries, Torrent Pharma, Titan, Sundaram Finance, and Abort India. The other 56, which is the vast majority, had messy, unpredictable journeys. Some shot up early and then went flat for years. Others looked completely dead before suddenly coming back to life. Many seemed genuinely broken at some point before eventually becoming legends. And that's the real insight here. The hardest part of owning a multi-bagger isn't finding it, it's holding it through the years when holding it feels like a mistake. Okay, now the part everyone's been waiting for. Look, patience does pay off. We took this exact framework and ran it through the market as it looks today. And we found 5 companies that are quietly showing those same early stage patterns. Now, let me be very clear, this framework doesn't guarantee anything, it never did. Even with the right traits, only 1 in 10 companies eventually became a superhero. What this does is help you fish in the right pond. Whether any of these 5 become the next superhero, that's something only time will answer, but the signals are worth paying attention to. So let's start with stock number 1, which is Emmvee Photovoltaic. Most investors chasing India's solar boom go straight to the big, well-discussed names. Emmvee is not one of those names. And generally, that's the most interesting thing about it right now. They make both solar modules and solar cells, not just assembling panels, but actually making the cells that go inside them too. Now, why is the market still somewhat skeptical about this company? Two reasons mostly. One, the constant fear that cheap Chinese solar products flood India and crush domestic manufacturers. And two, Emmvee only listed via IPO in November 2025, so there is barely any track record as a public company yet. Institutions are still warming up to it. But when you look past those concerns and look into the actual numbers, they are hard to brush aside. In FY26, revenue more than doubled, ROCE hit 38%, ROE crossed 51%. The capacity story adds another dimension. Emmvee currently runs 10.3 gigawatt of module capacity and 2.94 gigawatt of cell capacity. Management's plan is to scale those to 16.3 and 8.9 gigawatt respectively by FY28. And they already have a strong order book backing it up, so this isn't just ambition, there's real demand sitting behind it. On the self-funding front, the big equity raise was the IPO itself, and much of those proceeds went to strengthen the balance sheet. Today, net debt to equity is minus 0.06 times. The company is effectively net cash positive. So they have financial room to execute what comes next without needing to dilute shareholders again. The risk here is execution though. Now let's move on to stock number 2, which is CPCL. Right now, everyone's looking at AI, defense, capital goods. Very few people are paying serious attention to refiners. So, what's CPCL quietly doing while nobody's watching? In FY26, CPCL achieved their highest ever crude throughput, 11.7 million metric tons, running at 112% utilization. Their gross refining margin for FY26 came in at $9.2 per barrel, comfortably above the Singapore benchmark, which is basically the industry reference point. But the more interesting shift is what's happening within. CPCL is actively moving toward higher value products. They are investing 1600 crore in lubricant based oils, a business with significantly better economics than standard refining. The management isn't just thinking about processing more crude, but they're thinking about what they make from it and upgrading that mix towards things with better margins. And the balance sheet too looks very clean. Gross debt to equity at just 0.18x, net debt below 1000 crore. In FY26, they paid a record 62 rupees per share dividend while also investing in expansion and maintenance. Now, the risk is that refining is a commodity business. CPCL can do everything right and still face pressure if global fuel demand weakens, diesel cracks soften, or crude prices move sharply against them. That's just the reality of this space. Now let's look at stock number 3, which is LT Foods. It sells rice. That's it, rice. No AI story, no defense angle, just rice under brands like Dawat and Royal. Yes, stay with me for a second because the story here isn't really about rice at all. LT Foods is in the middle of a quiet, steady transformation, moving from being a commodity rice exporter into something more like a global branded food company. And that shift, if it completes, changes everything. In Q4 FY26, revenue reached 2,938 crore. Branded Basmati is gaining share in both India and North America. And newer categories like ready to heat and ready to cook are becoming real, meaningful contributors to the business. Now, running through the superhero checklist, and a few things pop out immediately. Net debt to EBITDA at just 0.6x. Working capital days improved from 196 to 176, which means the business is getting more efficient with the cash it ties up in operations. And growth has largely been funded internally. The core trigger here is a re-rating story. If the transition happens, the earnings profile could look very different from today. But the risks are very real too. Rice prices can swing hard and fast, export policy can change without much warning, and investing behind brands costs money, which can pressure near-term margins. This is not a story that resolves in 6 months. Now let's look at stock number 4, BLS International. They make money every time someone in the world wants to travel abroad. They help governments manage visa processing, passport services, consular work, Aadhaar enrollment, and other citizen services across 46 governments in 80 plus countries. They have processed over 490 million applications. Not trending, not making business headlines, just quietly growing. At roughly 11,000 crore market cap, BLS isn't a tiny undiscovered microcap anymore, but it's also not that big yet. But the business model itself is very interesting. Most of the businesses spend money first and then they wait for cash to come in later. BLS is just the opposite. They get paid upfront by visa application, passport service. This is why the company operates with negative working capital, meaning the business model itself generates cash as it grows without needing external funding to support operations. In FY26, operating cash flow was 903 crore. The year ended with 1,434 crore of net cash on the balance sheet. They are growing and becoming more cash rich at the same time. Between FY22 and 26, revenue compounded at 37% annually and EBITDA at 66% annually. The most recent signal of scale was a 2,055 crore UIDAI order, which gives you a sense of just how large these government orders can be. But yes, there are risks. Government deals are lumpy. One delayed contract can make a quarter look ugly. Visa volumes move with global travel patterns and can slow down unexpectedly. Now let's move on to stock number 5, Sharda Cropchem. Instead of manufacturing anything itself, Sharda outsources production entirely and focuses on what is genuinely hard to replicate: registrations, market access, distribution, and customer relationships across global markets. Today, it holds 3,011 product registrations across 80 plus countries with another 1,004 applications currently in process. Now, let me tell you why that registration library matters so much. Getting a pesticide product registered in a country isn't like getting an app approved on the App Store. It takes years, sometimes a decade. You need data packages, regulatory submissions, trials, and approvals. It's basically a long, expensive, painstaking process. But once you have those registrations, competitors can't just copy and paste them. They have to go through the entire process themselves. That's the moat. The company grew without diluting shareholders. FY26 operating cash flow was 655 crore, completely debt free. 702 crore sitting in cash and liquid investments. And the numbers this year were strong too. FY26 revenue grew 22%, EBITDA jumped 69%, PAT surged 124%. Highest ever revenue, EBITDA and PAT all in the same year. And despite all of that, market expectations are still surprisingly moderate. But the risk here is timing. Regulatory approvals can move slower than anyone expects. An agrochemical down cycle can suppress demand even while the business quietly keeps strengthening underneath. Alright, 613 companies, 15 years, only 62 made it to the superhero club. And they all shared the same early fingerprints. When we ran today's market, through these signals, we found these 5 stocks. But I want to leave you with one single thought. The framework tells you what to buy, it cannot tell you how to hold it. So I want to ask you something before you leave. Which stock in your portfolio right now do you genuinely believe has what it takes to be the next superhero in 10 to 15 years from now? Drop it in the comments. We are genuinely interested to read them. If this video gave you one new way to look at the market, please like it, subscribe if you haven't already, and I'll see you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.